Imagine working your entire life, saving consistently, and reaching retirement only to realize the income isn't enough. You want to enjoy life, travel, help your grandchildren. Maybe cover unexpected medical costs without constantly worrying about money. Millions of people depend mostly on Social Security, which averages roughly around $2,000 per month, often barely covering basic expenses. How to make money work for you? Most people fail to consistently beat the market. Meanwhile, simple index funds, which just track large groups of companies, capture the overall growth of businesses and industries. In other words, instead of trying to pick the next winning stock, you participate in the success of the entire economy. After analyzing historical cycles, long-term performance data, these 5 next index strategies stand out as the most powerful engines for the next 2 decades. They capture the entire U.S. economy, the strongest global corporations, mid-size growth companies, international diversification, innovation-driven technology. Index Fund Number 1. Fidelity 500 Index Fund. If someone wanted the purest exposure to the strength of American corporations, the S&P 500 would be the obvious starting point. FXAIX tracks that index. The S&P 500 contains 500 of the largest companies in the United States, representing a massive portion of the country's economic output. Companies like Apple, Microsoft, Nvidia, Amazon, Alphabet. These businesses dominate global industries and generate enormous profits. Because of that, the S&P 500 has historically delivered strong long-term results. Over the past decade, the index produced total returns above 230%, reflecting the explosive growth of technology and innovation companies. The expense ratio is only 0.02%. That means nearly all the investment returns remain in the investor's portfolio. In long-term investing, even small fees compound into significant losses over decades. What happens to $100,000 in FXAIX over 20 years? Let's assume a conservative long-term annual return around 10%, which is consistent with historical S&P 500 averages. $100,000 invested for 20 years. After 10 years, about $259,000. After 20 years, about $672,000. And that doesn't even include additional contributions, but relying only on the largest companies has limitations. Index Fund Number 2. Schwab Total Stock Market Index Fund. While the S&P 500 captures the biggest companies, SWTSX represents the entire U.S. stock market. This fund tracks thousands of companies, large, mid-size, small emerging firms. The portfolio holds more than 3,000 stocks, meaning investors gain exposure to nearly every major industry in the country. Technology, healthcare, financial services, consumer businesses, industrial companies. Some of the top holdings include Nvidia, Microsoft, Apple, Amazon, Meta. But unlike S&P funds, SWTSX also includes smaller companies that often grow faster in earlier stages. Historically, these smaller firms contribute meaningfully to long-term market returns. Over the past decade, SWTSX delivered roughly 218% total returns. That growth highlights a powerful investing principle. Owning the market is often better than trying to outsmart it. What $100,000 could become? If a $100,000 investment grows at roughly 8 to 9% annually, which aligns with long-term total market averages. After 10 years, about $236,000. After 20 years, or about $560,000. Index Fund Number 3. Fidelity Mid-Cap Index Fund FSMDX. Large corporations often grow steadily. Small companies can grow explosively but carry higher risk. Mid-sized companies sit right in the middle. That's why many investors consider them the sweet spot of long-term investing. The Fidelity Mid-Cap Index Fund tracks the Dow Jones U.S. Mid-Cap Total Stock Market Index, focusing on companies that are already established but still expanding. These businesses are usually past the fragile startup phase, gaining market share, expanding into new markets. The fund holds more than 800 companies, which spreads risk across many industries. Industrials represent the largest portion, followed by technology and financial companies. Over the past decade, the fund gained roughly 124%, showing steady long-term expansion. If we assume a moderate 8% annual growth rate, a $100,000 investment could grow to roughly, after 10 years, about $216,000, after 20 years, about $466,000. Index Fund Number 4. Fidelity U.S. Sustainability Index Fund, FITLX. The next index fund focuses on a trend that has gained enormous attention in recent years. But this fund is not just about environmental or social standards. It still prioritizes high-performing companies. The Fidelity U.S. Sustainability Index Fund tracks companies that meet strong environmental, social, and governance (ESG) standards while maintaining competitive financial performance. The portfolio contains around 280 companies, many of which are leaders in innovation. Some of the top holdings include NVIDIA, Microsoft, Alphabet, Tesla, Eli Lilly, MasterCard. These companies sit at the center of modern technological and economic trends: artificial intelligence, digital infrastructure, biotechnology, global payment systems. Over the past decade, the fund produced average annual growth of roughly 14%. However, higher growth usually comes with more volatility. Technology-heavy portfolios can experience larger swings during market corrections. If the fund maintains a long-term growth rate around 10 to 12% annually, $100,000 investment could potentially grow to, after 10 years, about $310,000, after 20 years, around $960,000. That diversification helps smooth volatility. But one critical element is still missing: international exposure. If all your investments are tied to one country, your results depend entirely on that economy. History shows that leadership rotates. The U.S. dominated markets for years. Before that, Japan experienced explosive growth in the 1980s. European markets led at different times as well. That's why professional investors rarely build portfolios focused on a single region. They include global diversification. And that brings us to the final index fund. Index fund number 5. Vanguard European Stock Index Fund, VEUSX. The Vanguard European Stock Index Fund provides exposure to major European economies. Countries such as Germany, France, United Kingdom, Switzerland, Netherlands. These markets contain some of the most stable multinational companies in the world. Brands that operate across continents. Companies like ASML, Nestlé, Roche, SAP. These firms generate revenue globally and often produce steady dividends. The fund itself holds over 1,200 companies, which spreads risk across many industries. Financials represent the largest sector allocation, followed by industrials and healthcare. That balance makes it different from the technology-heavy U.S. indexes. European markets historically grow slower than the U.S., but they provide important stability. Over the past decade, the fund gained roughly 61% total return. However, dividend payouts tend to be higher than many U.S. growth funds. That makes international exposure valuable for long-term income generation. Now let's combine all 5 funds into a balanced strategy. 25% FXAIX, U.S. large companies, 25% SWTSX, full U.S. market exposure, 20% FSMDX, mid-cap growth companies, 20% FITLX, innovation-focused companies, 10% VEUSX, international diversification. This structure spreads capital across multiple economic drivers: large corporations, emerging mid-sized businesses, technology innovators, global companies. What happens to $100,000 in 20 years? If the portfolio averages roughly 9% annual growth, which aligns with historical long-term stock market returns. After 10 years, $100,000 to about $236,000. After 20 years, $100,000 to roughly $560,000. And that assumes no additional contributions. Add regular deposits and the outcome changes dramatically. For example, $100,000 initial investment, $500 monthly contribution, 9% annual return. After 20 years, the portfolio could approach $900,000 to $1 million. That is the power of time working with capital. Why index funds continue to win? Research repeatedly shows that most actively managed funds fail to beat simple index funds over long periods. That's because markets are extremely competitive. Index funds avoid that battle entirely, which historically has been enough to build substantial wealth. Low fees, broad diversification, long-term compounding. Those 3 elements consistently outperform complexity.